All right, what's going on, everyone? My name is Declan O'Flaherty, and this is Equanimity. This is my first video, and really what I'm trying to do with this is I want to try and help people understand my investment philosophy. And so throughout this video, I will share both my process, how I got here, and then provide you with a few examples, including an analysis of Nvidia, Tesla, and a bonus company as well. So, how did we get here? Well, I've been investing now for about 5 years, and really it started at the age of 21 when I made a discovery and learned about its potential, and then ultimately wanted to try and do something with it. Now, throughout that process, I spent a lot of time reading books and came across Warren Buffett's philosophy, and that had a major influence and impact on me. And I started to see investing in a whole new light where really, if you could find and understand the quality of companies, you could outperform the market and also have a greater level of certainty overall. Kind of take out the guesswork that a lot of investors associate with it. And I really hit the ground running. So, this started again, spent a lot of time reading, listening to podcasts, and then I began developing my own process. And I've continued to refine that over time. I spent a lot of time talking with other people about it and sharing my passion for it. And ultimately, right out of university, this led me to landing a job with a financial media company. That was a great opportunity to just really hone my craft as well as kind of develop my media skills, which definitely still need some work. And I mean, even as you're looking at the setup right now, it's still a work in progress. The lighting's kind of whack. I'm using my wife's AirPods right now, and we're going to make this thing a whole lot better as we progress. But kind of my goal is to make a video every 2 weeks and try and just expand this. This is going to be some form of engagement. I want hopefully the audience to interact with me, provide pushback on my analysis, but also offer ideas, ask questions, and I would love to answer them. I do have some experience doing some podcasting for some time now, so hopefully it flows well, but I'm just going to basically kind of take it and run with it and see where this thing goes. So just a little bit more about my philosophy. Really what I do is I only invest in individual stocks. There's a lot of conversation around investing in ETFs and alternative assets, whether it's Bitcoin or gold, different heavy metals, commodities, derivative trading, all that stuff. And what I tend to find is one, it's a lot more hard to value these assets. And two, you're more than likely going to lead or end up over the long term with poorer results. And again, really, this is just an extension of Warren Buffett's thinking, and I've tried to make it my own. But what I think investing really comes down to is two things. First is understanding quality and finding out and determining what is a high quality asset. And then two, knowing the value of that asset. That, especially the value part, is something that I think a lot of people neglect and they tend to overlook. And a good example is, you look at a company like Nvidia and you'll think, wow, what an amazing business. They're in the fastest growing market of AI development. They're growing rapidly and it seems like there's no end. And it's a wonderful company. It really is a top-notch stock overall. The problem is that if you overlook the value of it and you overpay for it, you end up getting a mediocre return. And now's a good example. Right now, the company has a $4 trillion market cap. No business has ever done that until this year. And so what are you going to do? You're going to purchase it at the top and hope that it doubles to 8 trillion. Well, who knows when that will happen? Even 4 trillion kind of sounds absurd when you put it in the grand scheme. So a big part of my strategy is not only trying to understand the quality, but also figuring out what things are worth. So with that, how I kind of reached my process and got to this point in my investment journey is I essentially wanted to find as many high quality companies as I can. And I also learned how to value businesses. And what you're seeing here now on the screen, and I'll kind of walk you through what I've done, is I've collected about 80 companies that I think are above average overall, and now I'm comparing them across each other. And what I do with each of them is I create their own separate file, which I'll walk you through later about Nvidia and Tesla, and Euroseas is the bonus business. But what I'm essentially trying to track is their long-term performance from a financial standpoint. I'm looking at things like their revenue, their net profit, their book value, or their shareholder equity, which, if you're not familiar with, is essentially what is left after once they've covered all their liabilities. So shareholder equity is simply assets minus liabilities. And then the last one, and arguably the most important, is their free cash flow. So as you can kind of see here, we have a breakdown, and I'll walk you through each of these columns and give you an idea of what I'm assessing, and then I'll kind of push it and take it to the next level. So what I'm doing here first is free cash flow, and I'm using this free cash flow to measure against the free cash flow yield here, which I'll get into a little bit later. But at the gist of it, when it comes to direct numbers from the company, I really think that there is no more important value than free cash flow, because what it essentially is the cash that the business retains after they've paid off everything, all their expenses. What is the actual cash that is left over at the end of the year? And that is the key indicator, as you'll see as well, to determining the value of a business. Moving on here, I have a weighted average ranking system that, again, I'll kind of dive into more detail shortly here. But this kind of essentially provides me the levels of quality compared to these other businesses. Because what an investor should know is that you should say no more than 99% of the time. And just to add or put that in perspective, I probably looked at more than 1,000 companies, and most of them don't even come close to fitting kind of my criteria for what I think is a good business. From there, like I said, I have about 80 companies here, but that doesn't mean that I'm necessarily going to invest in them. I do want to track them because I think they're overall above average, but still, they're not necessarily portfolio material, let's say. And realistically, and in future videos, I'll kind of dive into my portfolio, but I only own 10 companies at max right now anyways. And that's just because, really the best opportunities out there don't come that often. And so you really want to be diligent and stick to your 10 best ideas. There's a good example by an investor, Joel Greenblatt, who essentially did this study and found that with 18 companies in your portfolio, you mitigate 96% of non-systemic risk. So what that essentially means is just the individual risk of every company. And so after that, as you keep building, you're and you buy more and more stocks beyond that point, you're not really reducing your risk at all. What you're doing instead is earning your returns. And just because this is a good segue in that element, that's why I don't necessarily invest in ETFs, because if you think of something like VFV or anything that tracks an index like the S&P, the NASDAQ, anything like that, it's going to cover more than 18 stocks. In the S&P, for example, you have 500 companies. So not only are you getting the best businesses, arguably, but you're also taking on a lot of bad companies within those 500. And it's gonna, let's say, prevent you from losing it all, but it's also going to hinder your returns. And so I am ultimately striving to generate the highest returns I can in a realistic and strategic way that I believe mitigates risk but produces the highest returns. Now, moving on, you can see the companies here, and we can definitely dive into more of them as this series continues, but this just kind of gives you an idea, their ticker, as well as the industry that they're in. Now, what you're seeing in these yellow highlighted cells is what I believe are, say, the 5 most important indicators of fundamental strength for a company. And so the first one is the return on invested capital. And, I think it was Charlie Munger who basically said that over the long run, a stock's performance from a price standpoint will ultimately mimic the return on invested capital the closest. And the reason why is because it literally is whatever the company brings in terms of cash. So whether that is various equities, or I shouldn't say equities, but assets, whatever assets they take on, whether those are physical machines or purchasing other businesses, buying back stock, any of that, that plays a factor in driving their returns. Are they within the business themselves making good investments internally? On top of that, a business doesn't just have to take on equity or have liquid cash. They can also generate or produce debt. And so what that does is obviously a business is going to use that debt to fuel their growth further. Return on invested capital is basically the net income of the company, so essentially their profits divided by their equity plus their debt. And it is a more conservative metric than return on equity, which only has equity in the denominator. Because again, let's say you have a bunch of assets, you're generating a decent return, but if you don't factor in how much debt they're taking on, then it can kind of lead you astray and make you think that the company is better than they are. If they have a debt to equity ratio of like 500, where their assets or their equity to their debt is 5 times the amount, it's not really necessarily performing at the level, and there's a greater level of risk. So return on invested capital is my number one indicator. I think it is the biggest or the best assessment of quality, but there's also complementary ones like the profit margin. And essentially what this is, how much of a profit do they capture after the cost of running the business is produced or taken care of. And so what I like to do with both of these is I want to assess that on a 5-year basis, because any single year can be an outlier and you can have swings and fluctuations, good or bad. And so by normalizing it over 5 years, you're getting a much better picture. So what you can see here is an idea of the highest producers of return on invested capital based on my list right now. Number 1 is Apple. And it's quite impressive, but if we dive into Apple at some point too, you'll notice that for them, they've actually been reducing their assets overall and their equity as well as their debt. And this is actually bolstering the company's return on invested capital despite having just a growth rate of 4%. Now, as I said, this is number 1 metric, but profit margin also is very important. You want a company with a high profit margin because that ultimately means that they're capturing more. And it's also very much a good indicator of performance within their own market. So you'll see here that Visa and MasterCard have they're 2 of the best businesses in the world. They have a duopoly in their market, and you can see that because they have a profit margin that is so strong. And if you try and look at other competitors who are maybe trying to penetrate this market, what you'll find is they're going to have a much more difficult time, because a company like Visa or MasterCard could essentially cut their prices in half, go into a price war with competitors and squeeze out those companies that don't have as much cash or don't produce as much cash, and they'd still be all right. If Visa for a little while fell to a 25% profit margin, so they dropped 50% from where they at today, they are still going to be in a great position. They're still bringing in cash and overall in a better position than they were the previous year. This is a lot more difficult for other competitors, so that's why profit margin is also very valuable. Now, I'll try and expand this a little bit, but I also look at their growth rate, because you do want to see if the business is mature, where it is, if it's growing at a good clip, but it can also be misleading. So you'll see this better when I look at the individual companies, but what I'm essentially doing is a weighted growth rate. I'm looking at their 3-year compounded annual growth rate, their 5-year compounded annual growth rate, and their 9-year compounded annual growth rate for revenue, net profit, book value, and free cash flow. And I have a weighting system based on what I think are the most important, but generally what I value more is the longer term performance compared to the shorter term. So that essentially means that I put a heavier emphasis on that 9-year compounded annual growth rate compared to just the 3-year, because again, anything can happen in 3 years, but can you do it time and again, year over year, and build that long-term sustainable success? As an investor, the main goal should be is to find a business, purchase it at a good price, and then sit on it and let it just continue to grow and create value, and essentially let them do all the work while you benefit. Overactivity can hurt you. And so anyways, what I'm trying to get at is that a company that can demonstrate over the long run that they're growing at a very high clip is a good reinforcement. But again, you want to factor in all these pieces here. It's not just any single metric, because a great indicator can be, one single indicator can once again just mislead you. From there, this is a valuing metric here. So free cash flow yield is essentially the price divided by, I'll zoom in here on the formula here, but it's essentially the free cash flow that the company produces relative to their market cap at present. So again, the higher the free cash flow yield, the better value you're essentially getting, because a great example here is with Euroseas, is they produced about $123 million in free cash flow last year, but they only have a market cap of 432. So they're easily getting nearly 0.25% of their cash back. And it's like, you can kind of picture it like, well, if I paid for the company at $432 million, how long would it take for me to make that back in cash? And for Euroseas, it would only take 4 years. Go further down the list and you see how much lower this diminishes over, and it's very rare to find any company above 10% here, but that's a great indicator. And realistically, this is going to show you once again kind of what return you can expect, but it can also be misleading as any of these. And yeah, I'm probably rambling on a bit, but I'll try and focus in. Next up is debt to free cash flow. So this is very similar in the sense what it's doing is the debt divided by the free cash, and it's essentially telling you, do you have enough cash that you're bringing in on a single year to pay off all your long-term debt? Anything above 100% means that it's essentially going to take more than 1 year, and anything less means that you could essentially pay it all off in a single year if you wanted to. So debt, what you'll realize, is probably the biggest risk to any business, especially if they're not profitable. Because no matter the time, those that give the debt or lend out are expecting that they're going to be paid back not only interest plus their principal. And if you don't have the money to cover it, that's when bankruptcies happen, and that's when a company can declare or assets can get seized and a business will go to zero. There's very few other instances other than, say, with a startup that just is running out of money as is, that you'll find a business will go to zero otherwise. So, a bit of debt is fine, but you don't want to get too crazy with it because you can definitely run into a lot of trouble. Next here, stock price, simply what they're trading at, relatively close anyways. And then unfortunately, Google Finance for Canadian stocks, I have to manually input it, but it's just a small hassle. Next here is their shares outstanding, and this is measured in millions here, so it doesn't matter too much to me. I don't necessarily care as much about stock price and shares outstanding as I do about the market cap relative to the company's value itself. And this highlights an important piece of my strategy, but also I think something that everyone should take is that you should try and look as if you were purchasing every stock as like you were going to buy the whole company. You want to think in this way because, one, you're going to treat it like, well, if I was the owner of the business, how would I want to run it? Is the company running effectively? Should things change? Are you satisfied with these things? Sometimes stock price can be misleading because, again, let's say a company is trading at $50 per share and it's overvalued. Well, you might think that compared to a company that's trading at $450 per share is a lot cheaper. And without considering what the business is worth as a whole compared to what the market perceives it's worth right now, you're going to get misled. And I have this conversation time and again with people who get lost in what the share price is and where it was without actually, again, factoring what the real value is. So kind of touched on it here, but again, market cap, this is what the market has it worth. So this is essentially the stock price times its shares outstanding, and this is what you'll see if you look on Yahoo Finance or anything. This is the price they're coming at. Now, my personal valuation is what I believe is a very key differentiator for me, and has helped me find a lot of high quality businesses, but at a great price, and help me generate returns that have outpaced the market overall. So I'll dive more into this on an individual side, but this here is going to be my most important indicator of what a business is worth and whether I should make an investment or not. This here just is the over under of that. So anytime you see a negative here, I'll go the other way. This is showing that the company's undervalued by that amount. So basically, Medifast, for an example, you could say that at this time it's trading at 87% lower than what it's truly worth. And you just go down the list, and what you'll see is that there's a lot more overvalued companies than there are undervalued businesses. From there, we'll slide over here. But what I've essentially done is, because now that I have all these, say, quality companies that I'm looking at, I want to see how they stand against each other. And here I've just built a basic ranking platform. So you'll notice that, say, with return on invested capital, that Apple right now has 64%, Medifast is at 58%, Alta is at 48%, and they rank 1, 2, 3, and the list goes down to the lowest ROIC. The same is true for profit margin, growth rate, free cash flow, debt to free cash flow, and the over-under, which is this valuation here. Combining those, here's my weighting. And as I kind of said before, is I give the most important. So this is for anyone who hasn't used a weighted average. This essentially equals 100%. And the higher allocation you give to these things, the more important they are. So you can see here, return on invested capital is my number one indicator of quality. And I believe it is the most important element to this whole thing. Next is profit margin. Again, strong indicator of a company's performance and the general strength in their market. Do they have a monopoly, or are they in a position where they can outcompete competitors? Next up is the over-under, because value is a very important piece. And as I've said before, but I'll say it again, you do not just want to buy high-quality companies at any price. If you can get them for a discount or at a good price overall, you are going to do so much better on your investments. From there, debt to free cash flow, again, you don't want too much debt, so a good position overall keeps it safe. Make sure that you're not going to go to zero with any of your companies. Free cash flow yield, again, another valuation indicator, less important than over under, but it is also valuable because, once again, free cash flow, single most important metric from within a business that they produce. And then lastly is growth rate. And that's just mostly because it can be misleading. Again, you don't necessarily just want to buy a company because it's growing really fast on paper. Could be doing that just for a couple of years, but can it sustain those growth rates? Less important than the others. So that kind of gives a breakdown here. And as I've said, this ranking system produces then what I believe are the best companies compared to the worst. So of the 80 or so businesses that I own, Euroseas right now is ranked number 1 across the board, and this is just a good indicator. We can go through it quickly at a high level, but you can see they have a 26% return on invested capital, way above average for sure. Solid business there. Their profit margin's 45%, so that's pretty much in the range of Visa and MasterCard. Growth rate's not as strong, but once again, if it is less important than the other factors, because if you're pulling in lots of money and making smart investments, your growth rate within it internally does not play as big of a factor. Free cash flow yield, nice and high. It's the highest so far that we have. And again, essentially, if you bought Euroseas right now at a $432 million market cap with about $123 million in free cash flow produced every year, you would get that paid back in 4 years' time, which is way above average. Let's say it takes typically a company to double its value on average about 7 years, and that's using a 10% compounded annual growth rate. Again, I'm talking a lot, providing a lot of information, but I can definitely go on in more detail about all of these things in future videos. And then lastly here, as we were saying, is debt to free cash flow. Solid. It's they have more debt than, say, they could pay off in a single year, but it would be less than 2 years. And so they're in a great position overall. I see no concern with the company floating around 100% to 200% debt to free cash flow overall. Now that we've got there, I think it is important to kind of see the worst companies too, though, because you generally would look at these businesses, and we have a lot of conversations, and you would say that, well, maybe I want to make an investment in the companies. I've heard a lot of people talk highly about these businesses, and they are good companies, but compared to the best of the best, they are still bottom tier. And again, you want to say no to more than 99% of the opportunities that you come across. So here you can see Brookfield is ranked the lowest. This is one that I've heard a lot of investors talk about, and I just really have not been able to wrap my head around where their value is coming from. They have a ton of debt. They are their return on invested capital is barely over 0% here. Their profit margin's almost just 2%. Growth rate 0.8%. And right now, because they have negative free cash flow of $830 million, they have a negative free cash flow yield. Same with their debt. Can't even measure it really because essentially they have no cash that they can pay off with. Go up, Palantir, another really, really good company and a new business, something that has exploded this year. But at this time, if you look at the numbers, they're not really necessarily in the strongest position. They're still in early business. They're still trying to build that presence and sustainability. And there's just a lot of questions left about what are they truly worth? Can they sustain themselves? And don't get me wrong, I think it's a great business, but it more than anything, what this does is it prevents me from investing in them now. And there's a good saying by Warren Buffett that essentially, it's better to say no to an opportunity and make a mistake of omission rather than committing to something and then getting burned and losing your money. And so for now, I can take a pass on any of these businesses until I believe that they are worth the value that I truly perceive them to be. Again, just go quickly here, but you can see Estee Lauder, CBRE, the real estate builder, Axon, which creates the tasers for police, as well as the body cameras and everything. Really cool company, and I love learning about it. It's just, again, not a great deal right now. CrowdStrike, cybersecurity, Shopify, Canada's biggest company. So you get a good idea of what are weaker companies, at least relative to how I compare businesses as a whole. Now, this is kind of where I think we can start to dive into the individual businesses, and I'm going to purely look at them from a financial standpoint right now. But again, if you ever want me to analyze a company, provide you details on the products they create, what are their major costs, who are their management, and a whole lot more, I'll definitely do that. But I think for now, just based on where this video is going and what I kind of aim with this first one, is I just want to give you a few ideas of what I'm looking at on an individual basis, and then we can expand from there. So we're going to start with everyone's darling child right now, Nvidia. We'll wait for it to load here, but this is essentially what I do for every individual company here. And what I'm looking at is what I do is I want to gather as many years as I essentially can, at least 10 is ideal, of historical data that provides me a very good glimpse of what a business is, its capabilities, and where it's headed. And so what you'll notice here is I track things on an annual basis. So Nvidia's next 10K comes out in January. So this will be updated. I'll add 2026 here, and we'll have an even clearer idea. But overall, I'm content. You don't need, say, the most up-to-date information all the time. As long as you're looking at it from a longer term picture, overall, you can usually get a good idea of what a business's quality is. And we don't got any charts, but what you'll see and kind of what I'm looking for first and foremost when I am just quickly scanning any stock is you want to see any of these lines trending from left to right in a positive and upward direction and accelerating. And if you look here at Nvidia's revenue, you'll see that in 2013, they made about $4.2 billion in revenue. In 2018, that grew to $6.7 billion. And then really in the past couple of years, they have just exploded. And this past year, they made over $130 billion in revenue, which is phenomenal. It supports everything that has been said about the customer demand, the quality of their GPUs and their hardware, and it is attracting every major AI company out there, and that is reinforced with their sales growth here. Phenomenal performance, and again, it is a top-tier business, but, as we'll see, and we'll talk about value, you may gain a different perspective about whether it's a good investment at this time. The same thing, though, is true about their net profits. $500 million or closer to $600 million in 2013. 2018, they made $3 billion. And then in 2025, they made $73 billion in net profit. So again, phenomenal. Overall, I value profit or net income a lot more over revenue because in a lot of ways, a company can attract more sales. But if they're not keeping those dollars and their profit margin isn't keeping up with that growth, then it can almost be a detriment to have too much sales if the profits aren't adding at a same incremental rate overall. So phenomenal here. They have clearly shown once again just how dominant they are, and we'll take a quick glance because I'm talking about profit margin, just how that has really expanded in the past couple of years, close to 13% in 2013, 45% in 2018, so a huge year for them overall there. And then they kind of wavered a little bit, but again, 2025, 56%. That is a clear dominant player, and they really are the best in the business when it comes to building AI hardware right now. Next up is book value, as I talked about. So that is essentially their assets minus their liabilities here. And you want this positive because that essentially means that, again, if they paid off all their debtors, if they covered all their liabilities, what would they have left over? And it's the same story. 4.8 billion in 2013, 2018, 7.4 billion, and then in 2025, 79 billion. So they are keeping more and more or retaining more and more of the value of their assets, and it's a phenomenal position to be in. You just want to see that strong growth there. I also want to look at long-term debt, and again, this is just a measure. You want to make sure that it's in a reasonable band here. And once again, right now, Nvidia has about $8.4 billion in debt. From a profit standpoint, they were making $73 billion in a year, so they could easily pay it off within a year. Like there's no concern there, and a little bit of debt is always a good thing. It provides additional capital and something that you can use to grow the company. So if you use it wisely and you're generating good returns, then there's not really much risk there. As I kind of said before, return on invested capital is my most important measure because it is a reflection of how management is using their money and are they deploying it effectively? Are they good capital allocators? And as I said before, it's simply net profit divided by their equity plus their debt. So this is a good conservative metric, but it also will highlight what the company should be growing overall. And I like to look at it on a 5-year basis just because, again, 83% is phenomenal. Clearly Nvidia's best year, but is 83% realistic over the long run? It's hard to tell, especially with, say, their track record in the past. And so by balancing out across these and creating an average, you just get a bit more of a conservative evaluation overall of return on invested capital, and just something to be aware of. But again, if you can find businesses that are generating anywhere upwards of 10% and beyond, you're already on the right track. You're already above average, and you're in a better position than most investors overall. Next up is free cash flow, which is generated simply by the operating cash minus their capital expenditures. So operating cash should track very similar to net profit, but it tends to be a more conservative value. There's a few more things that essentially are taken out along the way in a financial statement. But what it really comes down to, it's the cash that you're making after you pay off most of your business. But there is an element, and this is where capital expenditure, where essentially your day-to-day operations, everything that you cover in a single year is captured within operating cash. But a company will make more long-term investments. They will develop infrastructure. They will purchase out, say, property and different machinery and things to keep their company going and improving over the long run. And that's what capital expenditure, it's still something, it's an expense, but it's a more longer term investment type of expense, something that they're developing probably over a couple of years, but hoping to make benefit or create an impact that lasts for 10 years and beyond. And so you want to just take out that remaining amount, because this gives you free cash flow, which is truly the amount of cash that the company is retaining after everything is paid for. And it is, again, you want to have a free cash flow positive company, but you also want to see one growing. And once again, just a quick rundown of Nvidia's here is in 2013, they had $640 million that they were retaining in free cash. 2018, 2.9 billion, and then in 2025, nearly $61 billion of free cash flow. So insane. Now, there's another part of this that leads into how you value a business. And what essentially is the breakdown of what a company is worth is the amount of cash flow they will produce into the future, into perpetuity. And what that essentially means is if you could forecast out as many years as the company will exist, how much cash are they going to bring in that time? And that is going to essentially tell you what the business is worth. Now, there is another piece to it where not all money is equal in the same amount of time. And so dollars earned this year and next year are more valuable than those in the future. But to correct for this, you need to have a discount rate. And the one that I've always used is 15%. What the discount rate is essentially doing is it's measuring back on the basis of how, like, what how do I say this? It is the rate that is going to essentially track like the hurdle rate that you wanna surpass or outpace in order to generate that return. So if free cash flow is growing at 15% every single year out into the future and you discount it back at 15%, essentially the value of the company today would be the same as it would be in the future. If it outpaces that, you're generating a higher return. And typically, people will use a discount rate of 5%, use the treasury bond, so essentially the risk-free rate as a good measure, but this is closer to 3 to 5%. So I think it's a bit too aggressive and it can inflate the value of businesses. 10% is generally the long-term average of the S&P 500. And so once again, good, but it's essentially average. And we want to do better than average. So let's use a more conservative thing that's really going to weigh down the value of those future dollars so that we have a good idea. And we know that when a stock is trading below what it's worth, that it is really creating that value. So I think that's a good segue into this element of the analysis here, where what I'm essentially doing here is, as I mentioned, I like to, from a growth rate standpoint, I am looking at 3 years, 5 years, and 9 years. And here, what I'm tracking, just so you can see, is how much revenue they're making at present, divided by what they were doing essentially starting at year 0, so 3 years ago, and then doing that over, breaking it down by a 3-year basis, and this produces the compounded annual growth rate. And you can see Nvidia's are phenomenal on a 3-year basis, like truly exceptional. 69% for revenue, 95% for net income, 44% for book value. Free cash flow is at 96%. But again, anything can happen, and Nvidia is a prime example. The AI boom has really been happening since 2022, and so they've just been raking in dollars over the past couple of years. Is it a great indication of what the future holds? Maybe, but there's a lot of pushback right now with AI, so there's no guarantees there. That's why on a 5-year basis, good picture, but even better is it on a 9-year. And again, when you look at Nvidia's growth rates overall, phenomenal as it is, like, they are growing well above average right now, and so you can be pleased if you are an investor right now just to see that amount. It's just a matter of, can they sustain it? And at least even if they cut their growth by 20% right now, or 50% right now, and they were hovering around about a 25% growth rate overall, they would still be in a great position, and you'd be happy as an investor there. So that's what I'm talking about here, the weighting. So I've just essentially created a weighted average for each of these, where I give about 10% of the value to the 3-year, 30% to the 5-year, and then 60% to the 9-year. And this just essentially means that I'm weighing 9-year compounded annual growth rates much heavier than the shorter term elements here. That produces these numbers here. From there, I also don't value revenue, net income, book value, and free cash flow equally. As I've kind of said throughout this video, the most important metric for me is free cash flow. And so I'm giving them about 50% of the value in my weighting here. The next up is book value, because again, if you pay off all your assets or pay off all your liabilities and you have assets left over, that is a strong indication of, a business is going to be all right. And if the worst things happen, that you as an investor, you're going to be in an all right position. Even if it does go to zero, you will retain, or the company does go bankrupt, you as an investor would retain some amount of your capital. You wouldn't lose it all. Next up is net income, which is definitely important, but not as important as the other factors. And lastly is revenue. And from here, you see that by creating a weighted average, I'm getting essentially the growth rate that I believe the company is at right now. Now, as you see, Nvidia right now is at a 59% growth rate annually, which is absolutely absurd. I should say this first. So because it is so high, and again, you want to be generally conservative. You don't want to be over the top, because I just don't know, and really nobody knows, if Nvidia is going to be able to sustain this growth into the future. So I like to cap it at 25% at the most that a company can grow their free cash flow in any year. And then what you'll see here, and I'll slide over here quickly, is I'm essentially using that growth rate for the next 5 years. So this is what it would grow, and there's a lot of decimals here, so I can see if I'm on the wrong thing. But anyways, you can just see the growth there. But then like I said, a company is valued by how much cash they generate into perpetuity. So after year 5, we're using a terminal growth rate, which I essentially just cut in half here. And that just gives you, again, a bit more conservative of a metric, because will Nvidia grow at 25% over the next 20 years? I don't know, harder to tell. So I like to cut it in half and provide a more conservative value. But that here is what this number is here. And then, as I talked about, there's discount rate. So this here highlights the number of, or the amount of free cash flow that they're expected to generate 5 years from now. But you want to divide that by 5 essentially to figure out, and that's just the power by the number of years to bring it back to present day here. And then lastly, just so I highlighted, is here's my risk-free rate of 15%. And so I should say my minimal acceptable rate, or discount rate here. I used to have a risk-free rate premium on top of it, but don't think it's worth it anymore. But what you'll see is, in reality, if you're comparing it to today's dollars, really they're making about $46 billion in free cash flow, which is, again, this is where the value of money over time really decreases, and you can see that it's essentially half, if not more, that is being slashed when you put it in this perspective. So what I'm essentially doing here then is determining their NPV, which is their net present value. So it's the sum of all their discounted cash flow in the next 5 years, as well as that discounted amount for their terminal value here, and that produces their net present value. And then the last part is you just want to essentially figure out what the value of their equity is. So you're stripping out any value that's tied to their debt here. And I'm actually going to change this number, because this should be in column O. I'm doing the wrong thing. So I will just ignore that for now. But what I'm doing is subtracting their debt and adding in their cash as well. And that gives me what I believe the business is worth today. Then you can see here that on a share basis, this is dividing their shares outstanding, and these are in millions. So this is 24 billion shares outstanding that they currently have. And that gives that I believe that I would want to purchase this stock at $85 or less, which brings me up to this point. And you saw these numbers on my company comparison here. My ROIC on a 5-year basis, debt to free cash flow, profit margin, free cash flow yield, and growth rate. So these are all the things that you see on this sheet that I was running it down, just how I measure and then track it there. But you'll see here that right now, Nvidia is trading at $182 per share. And again, I don't really want to buy it unless it's at $85 or less. So that's quite a premium that it's trading at there. But again, share price is kind of a harder picture. It's more difficult to wrap your mind around than looking at the whole picture. And so that's why you can see here that the company right now has a $4.4 trillion market cap. Again, the highest value of any company ever. And it's phenomenal that they've achieved it, but it's very hard to wrap my mind around purchasing it at this price, because one, if you buy it just to double your money, it has to reach almost $9 trillion just to get to that point, just to get 100% return. And that doesn't really seem worth it. So I think the company is worth closer to $2 trillion today. And that just means, and we can look here quick. So zoom in on Nvidia, which is right here, is that I think right now it's about 114% overvalued. So I know there's a lot of Nvidia fans out there, but realistically, this is a prime example, and the reason I wanted to use it is it's a high quality company. It's the best in their business. Nobody is even close right now, but they are overvalued. And if you purchase them at today's price, realistically, what you can expect is that their market cap is not going to stay at $4.4 trillion for long. I would anticipate that over time it is going to correct a bit. And we've been talking about an AI bubble, but this is a clear sign of that this business is just overpriced. People are hyping it up too much, and you should expect that it realistically should be traded closer to $2 trillion. Doesn't necessarily mean that my valuation is right, and as I've said, it is very conservative, but this is what it takes and what I believe protects me from making mistakes in the market and ensuring that I really do generate a good return. Now, I wanted to provide another example of a company that a lot of people love, and that is Tesla. So Tesla is another fan favorite. I have a lot of friends who are big fans of it, and again, Elon Musk almost has a cult following when it comes to his company. And, I don't blame him in the sense that he really is a visionary. He has produced many really fascinating and amazing companies and pushed the boundaries. And so you have to respect it from that standpoint. Now it's just a question of, well, do you want to invest in this company right now? So we'll do a quick run through. As you can see, starting with revenue here. They have grown tremendously. 2013, $2 billion in revenue. 2024, $98 billion in revenue. Massive growth. More than many doubles there, right there. So a lot of high quality growth, which is a solid standpoint. Net income. Here's a good example. For quite a while, the company wasn't actually making a profit and they were losing money. And this was a lot of the pressure in the early days that people were questioning, does the company really deserve what its valuation is because it's not profitable? But they turned the tide. They've demonstrated that they are the top electric vehicle manufacturer and then have expanded into so many other elements of their business nowadays with AI and as well as data centers tracking and even just the manufacturing process and development of these vehicles that they create. It clearly has demonstrated that they figured out how to be efficient, and that has turned the tide from being a profitless company into one that is making, at least in 2024, $7 billion. In 2023, they made $15 billion in profit. So they're clearly in a much better position than they were 5 years ago, and it's a lot stronger business overall. Again, moving on to book value, $667 million in 2013. Today they're making $74 billion, at least as of 2024. Phenomenal growth, very strong, good sign. Debt. Well, they have about $6 billion in debt right now. Once again, made about $7 billion in profit. And you can look at free cash flow as well. And they have $3.6 billion. So they could essentially pay off their debt within a year or two if they really wanted to. No company's going to pay off their debt all at once, or most don't anyways. Yeah, moving there, kind of already segued, but operating cash started at $265 million in 2013, $14.9 billion as of 2024. CapEx below that, and so they start to generate a free cash flow, and they've done so at least consistently since 2018. So that's a good 7-year stretch minimum that they've produced positive free cash flow. And again, we'll just look here, profit margins. Again, dismal, negative for quite some time as they were losing money, and they've improved and at a decent rate. And I think this is a good point about profit margin, thinking about it, but you also kind of want to compare these on an industry basis, because a hardware company or a vehicle manufacturer is going to have a smaller profit margin than a software company let's say a business like Visa that really has minimal costs of goods sold. Most of their again, the work is kind of done, and they just pay minimal things to keep the uptick of the business itself rolling. So compare it on a relative basis to industry peers. So you can't really say, oh, is 7% bad? Well, again, if it's compared to other vehicle manufacturers, and we can make a comparison of this at some point in the future, I'd say it's decent. Then return on invested capital, again, most important metric here. It was negative while their profit was negative, and since then they've improved with 2024 being all right, nothing extraordinary, but they had a good stretch here, and we'll have to see what 2025 in terms of an annual performance brings. As I've kind of run through this, you can see right here that their growth rate's about 23% overall, pretty solid. But once again, I just want to kind of skip over and get to the point about valuation. And today, I think that Tesla is worth about $402 billion, which clearly, right now, at a market cap of $1.4 trillion is way overvalued. So this is a great example, once again, of a solid company. They've definitely improved in recent years. They are arguably the top EV manufacturer, at least out west here, and they are in a much better position overall. But are they worth $1.4 trillion? I say absolutely not. They are worth a lot less. And so, again, you'll get yourself caught where if you decide and you want to think of it as if you're purchasing the business as a whole, if I bought this company today at $1.4 trillion and it's realistically only worth $400 billion, you are overpaying for this company by a significant amount, and you're probably, even though it's a good business, not going to generate a good return, and you may even lose money. And you're going to ask yourself, how the heck did I get in this position when they're doing all these things and they promise robo-taxis and they have Optimus and all these other elements to their company that should be adding value? These are the things that you're going to run into trouble if you overpay for stock. So that's just one thing. Again, solid company overall. I think Elon Musk is somebody that has clearly demonstrated an ability to create good businesses and do it time and time again. But as the market, which is very emotional and people tend to lose logic sometimes, it causes things to be overvalued, and they can be overvalued for some time. But does it mean forever that they'll stay there? Probably not. This essentially means that over the long run, they should return to around this value at this time. And even if it's half of that right now, let's say they're truly worth $800 billion, well, there's still over $600 billion of overvaluation there as is. So it really just shows that right now I want to steer clear of Tesla making an investment until I find a more attractive value that is reflective of their fundamentals. So now that I've kind of dogged on two of the best companies and two companies that people really like, now's the time to kind of provide you a different perspective. And this is a business that I guarantee most people have never heard of. But it is also a company that in the past year has generated me over 100% return. Just ignore this. But Euroseas is a shipping company out of the Mediterranean, and they operate really in the Eastern Hemisphere, but they buy these intermediate cargo ships, and they own about, I think last time I checked, 28 ships. But the company itself has been operating for over 150 years. And when you look at their financials, it reflects a management team and a business that operates arguably as efficiently as it possibly could. So this is a much different scale than the $4.4 trillion Nvidia and the $1.4 trillion Tesla company. Euroseas is only trading at a $450 million market cap. And you'll see that in their numbers here. 2013, they made only $39 million in revenue. In 2024, that has grown to 213. So definitely a few doubles there. Net income. They had a few years and actually a good stretch where they were not making a profit. But what they've done in recent memory has just exploded their profit overall, and they are retaining so much after all expenses that it is on or in comparison to companies like Visa and MasterCard in terms of a net profit margin. And you see that here, that obviously negative here. But now, over the past 4 years at least, they've generated above a 45% profit margin, which clearly shows that they are bringing in cash relative to their sales and retaining a high amount of that, which they can then deploy, purchase more ships, and just build their presence overall and do it in an effective way. This is again further reinforced by their return on invested capital, which was negative in the previous years, but has really exploded and ballooned in past years. And you do want to be aware. I think this is a good example here that as time unravels and the next few years unfold, you want to ensure that this doesn't fall or reach a point of concern that, say, goes below 10% or is just on a continual decline, because that is just a reflection, again, that management isn't making as good of decisions as they were in the past. And you want to ensure that they are always purchasing assets and taking on reasonable debt to generate profit that reflects the investments they are making in their business. If they stop doing that, you want to question, because are they really using that money wisely? Now, I've kind of talked about their growth of at least their fundamentals and their financial pieces, and you can see how their free cash flow is projected from where they stand here. But this is really where I want to talk about, because this is what I believe allowed me to capitalize on this opportunity. Is when it's all said and done, I think Euroseas is worth $764 million. All the free cash flow projected in the future, this is where I think it's at. And as I mentioned before, the company right now is trading at $450 million. So the market essentially has them overvalued, and by quite a substantial amount. If you go to the company comparisons tab here, you'll see that as it currently stands, it is about 43% below what it is truly worth. Now, the crazy thing is that early in the year, around April, when there's a lot of turmoil regarding tariffs and, say, the ongoing conflicts in the Middle East, Euroseas' value was pushed even further. The company was trading at a $250 million market cap, and again, I had it worth at least $750 million. So it was essentially 66% below what I thought it was worth. And again, going back to free cash flow, if we're talking about $123 million of free cash flow with a $400 million market cap, imagine what that's like when $123 million of free cash is still there, but you're buying the business at $250 million. You're essentially getting your return on investment fully paid back within 2 years, which is absolutely absurd. And this is where I was able to capitalize. I saw the price, I knew what the company was essentially worth and what the market was trading at, and I knew it was undervalued and that the fundamentals were strong enough to give me confidence to make an investment. And so I dived head first, made a sizable bet, and over the past year I've generated over 100% return. So now that I've kind of given you a glimpse, and this is the first of hopefully many videos, and definitely a lot of improvement in the overall presentation of it, and less rambling, less headaches for probably you all. What I'm trying to get at here is that what you can do with your investing, if you commit the time and you learn how to value businesses and understand their quality, you can improve your chances of generating higher returns without taking on more risk. This is something that I've applied over the past 5 years and have found decent success and have hoped to share with many people already. But now I think with this platform, I want to just try and take this to the next level and really shed light, provide a different perspective, and hopefully give you all a new idea on how to make this happen, because it really is valuable. I've learned so much through investing. It has become my passion, and I think everyone should do it as early as they can. But I understand that it can be intimidating. I can understand that this level of dedication is not necessarily attainable for everybody. But even if you just put in a little time, if you find 10 companies that you think are high quality and you can figure out how to figure out what they're worth, you're going to be in a much better position than a lot of people that, again, simply invest in ETFs or go chasing the next trends, or really even professionals. Like, that's a crazy stat that I never brought up in this video, but 90% of professional investors fail to beat the market. So if you want to be in that 10%, this is what I believe you can do it. And, don't take it from me. I studied Warren Buffett. I still studied Joel Greenblatt, Mohnish Pabrai, Howard Marks. These investors who employ a very similar strategy and have done it for decades at this point and proven that they can outperform most. So I'm just essentially trying to be a steward and a disciple of them and hopefully pass it on to the next generation. But, with that, I've probably already said too much on this video, and I can't wait for the next one. Make sure you leave a like, and if you really have listened this way, I really appreciate it if you'd subscribe too, because the more people we can reach with this, the better we can build a community around strong investors. So thanks again. This is Equanimity, and I'm signing out.